assuming that we are live on stage. So, Keith, welcome to the Single Malt podcast. Great of you to spare the time. And we've got a couple of topics that we'd like to exercise with you, but perhaps we can kick off with you outlining a little bit about your background and who you are, and how the topics that we want to introduce are relevant to your recent experience.
Thanks very much, David and Andrew. It's good to be here. The question of who I am is, I've often found in the past, is a tricky one to answer, or what I do. And that's only because over the course of my career, I've been in the privileged position to have been in so many different roles and at so many different sort of engagements that it comes from all sides. So from training as an engineer to working in the public sector, in the defense industry, through to being a global executive of a Swiss company, finding myself in private equity. I've at times found myself acting as a management consultant, at other times being an executive, other times being an investor, other times being an entrepreneur myself, and sort of within smaller and scale-up businesses and larger. And now, sort of more recently, even getting into the developer role of developing infrastructure and big infrastructure projects and working with both public and private sector. So I was trying to explain this to someone a little while ago, and I said, I feel a lot like the guy with the machete that when people are lost in a jungle, they call me to come and show them the way, hack a path through it, and show them how to get to the end result. And he said, I know what you are. You're a strategic pathfinder. So now if people say, what am I? I say, I'm a strategic pathfinder. I help people find the way to the right result.
That's a good analogy.
Yeah.
So what we've been doing, Keith, is we've been exercising the problem of how does local government work more effectively and efficiently with the private sector. And in the past, of course, there's been examples of things like outsourcing, and that often doesn't go well. And there's been some projects where the outsourcer has actually caved in, and the public sector have had to take back the keys and try to solve the issue. And that's classic examples are in home care providers, and another one, of course, is the big facilities management companies like Marillion and so on. And then more recently, we've also seen that the public sector has had to sell a lot of assets because they got it wrong in the first place and assumed that because the logic stood up, the actual execution would also stand up. And I think it's execution where things tend to come apart, and where a partnership rather than an outsource or a sell-off, a partnership could have legs, particularly with modern tools. And I know you've had a couple of recent experiences, well, one not so recent, and then one very, very recent, where the public sector more recently has, and the private sector come together in a major development. And in the past, you've gone the other way, which is the kind of traditional way of a local authority selling off some of his assets. So I think that would be a good place to start, if you could sort of give some experience of your thoughts on that.
Yeah, thanks, David. I've had a few cases which I think are relevant, and we'll get to what I'm working on at the moment, which is where I've been able to bring quite a lot together and really focus the mind. But while I was in private equity working for LDC, we acquired the NEC group from Birmingham Council, which was the first one that I'd like to mention. And in that case, it was a straight sell-off by Birmingham Council, with no retention of shareholding or any ongoing profitability and anything else. But LDC, I think the council, if I remember correctly, needed to do it to fill a hole that they had. LDC, on the other hand, got quite a significant asset, and I spent many, many months working with the management team at the NEC group to shape their strategy and their value creation plan as to how we as a private equity firm would get a good result. And a few years later, about 2.5 years later, we did actually sell it on for a tremendous return, more than double what we paid for it. And which is something that if the deal had been structured differently, if we think in the context of what we're talking about today, the council could have benefited from. And if I think back, I'm sure there would have been people saying, why on earth did the council sell off such a prize asset and fail to benefit from any of the upside following the private equity involvement? LDC did everything that they were expected to do. They did nothing untowards that you wouldn't expect a private equity firm to do, but there was a very good result, outstanding asset, excellent management team that was already in place when we took it over. And there was a reward, but there wasn't an additional reward to the council. So that's one thing that we could perhaps dig into. The other example also from my private equity days was the story of Forest Holidays, which was initially set up as a joint venture between the Forestry Commission and the Camping and Caravanning Club, who then also sold a significant shareholding to LDC, who would bring in development funding to be able to expand it and grow it further. Again, outstanding management team, but in that case, the Forestry Commission retained a shareholding in the asset, and so benefited when LDC progressed it and got subsequent investors to come in and so on. So in that case, similar sort of proposition, but different outcome because the deal was structured differently. And it's one of the things I've often asked myself is, why don't local authorities actually look at the deal structure, because that is where they will get their longer term result, and that will also bring about sort of hopefully a better return to them in the longer run. And there's all sorts of reasons, I think, for that. I think on the one hand, you've got different incentives on both sides. From a private sector perspective, it is incentivized on growing profits and getting a good financial return and building a bigger, better business. Whereas on the public sector side and the local authority side, you find that the focus is different. And we'll come to the project I've got in Scotland now because it touches on this. Whereas you might need to fill holes, but one of the things that I've found is that the risk appetite on both sides is also very different. So in the private sector, you find people far more open to carrying big risk, but then they want a big reward. Whereas in the public sector, you have people who are sort of reticent to take on too much risk, and there's not anything in it for them personally, so they don't really want to put themselves on the line for it. So that's just touching on one smaller thing to cover off. Just very briefly, and we can dig onto it and then sort of in a minute or two, is my project up here in Scotland, where this was actually a is a community-led project. Where the community there's community regeneration that's required, it's in a town called the Noon, which is about an hour west of Glasgow, and the community, after not getting the investment from the local authority and the public sector that it needed to regenerate itself, and just from a historical perspective, the Noon is where the US had their nuclear submarine base for many years before leaving in the early 90s. And when they left, half the town disappeared with a lot of the income that the town was getting. So, and it has often been on its knees ever since. So the community, looking to turn its fortunes around, came up with a big idea to put a gondola up and develop tourism in the town. And I was initially approached to develop a feasibility study and subsequently to lead the project through navigating how we get access and the rights to develop the land, how we get the funding in, and all sorts of things. And it's really that latter, when it comes to funding, is what sort of structure do you need to put in place that is attractive to public sector bodies, including the local authority and the governments, that is attracted to private sector, whether it's big pension funds or individual high net worth investors, and how do you keep the community engaged throughout through all of that. So lots and lots of lessons through all of those that are very, very pertinent to doing this. But I do agree with you that I think there's a big opportunity for public and private sectors to work together. But on both sides, it needs a little bit of flexibility and the sort of mindset to be willing to adapt models that to deliver the results that everybody wants.
Just a quick one, Keith. You keep referring to LDC. Now, Andrew and I know what LDC is, but rather than just the letters, perhaps you could unpack the letters for the people listening.
Yeah, LDC stands for Lloyd's Development Capital, which is a private equity arm of Lloyd's Bank. Very strong in the mid-market sector, good success track record of investing in sort of medium-sized businesses from about 10 million turnover upwards. The NEC was obviously a lot bigger. It was the biggest investment that we did while I was there. But we also invested in companies like Fevertree and others like it. And U-Switch was another investor. So whether across multiple sectors and everything else. So we essentially invested in companies and backed management teams. And I was part of the team that went in to work with the boards and the management teams to work out, now that we've made the investment, how do we get a good return on that and multiply it by 3 or 4 times before we exit it again. So LDC is one of the market leaders in that space.
But I'd like to understand the latest project a bit more in a moment, but going back to your first example where Birmingham didn't perhaps see the opportunity to hitch a ride with your, whatever you did to the NEC, position it better, maintenance, presumably, upgrading it, whatever it is. What do you think? Obviously Birmingham had built a massive, they took a risk on what they were building in terms of an asset originally. So the political vision was something that would obviously bring jobs into the area, lots of footfall, etc., etc. So that probably is pretty similar to a private sector vision. They're placemaking as a council. They're using their planning powers to make something happen. What do you think happened at the end? They just ran out of belief in their own ability to keep this one fantastic asset going. Whereas obviously the Forestry Commission could see that, they weren't going ever. We'll always be the Forestry Commission. We're using Keith's expertise in the LDs, the venture capital input to kind of leverage their expertise, but to keep a grip around the scruff of your neck a bit in return, because if you failed, that they all failed, but if you succeeded, they want to hitch something on your apron strings. So what do you think what was going on? Why the Birmingham did? Well, we can't speak for them. Why you think they didn't think, well, there's an upside to this?
It's a good question, and I wasn't part of the negotiations to acquire it, so I can't really comment on exactly. Like I said, I believe at the time there might have been a hole in their budget or balance sheet that needed filling, which was a big driver of why they needed to sell it off. Short
term.
Yeah, and I think that in my experience, because I've worked with so many different managing teams and CEOs, and not just in the private sector, but across the board over 30 years now. And you have to get down to the mindsets of the people and what the pressures are that they're feeling in terms of where they're going from a directional perspective. And of course, if you're an investor and you want to get your hands on the whole asset, you will exploit those pressures if they're there to be exploited and you're aware of. I'm not saying that's what happened on the NEC case, but I know from experience you want to maximize your advantage in terms of your investment. At the same time, I don't think it would have necessarily taken too much. And it does also come to the mindset of individuals, not only from that, but how broad-minded they are in saying, actually, there could be a big upside. Let's see what happens. Mm-hmm. So a lot of it will depend on who were the individuals in place at the time on the council side versus if you take the Forest Holidays case, who were the individuals that were on that side. In Forest Holidays case, clearly they had vision because they backed it, the sort of setup of the Forest Holidays venture in commercial forests to start with. So they were already on that path to how do we grow this further, but also get somebody that does have funding in maybe, I don't know what their case was. Sort of interestingly, on my Scottish project, Bob McIntosh, who was chairman of Forest Holidays at the time from the Forestry Commission side, is now on my advisory board on the Scottish project. So
I was going to ask you whether you could come down to a kind of a team sport, like a characteristics of a team that you'd want to put together from all your 30 years experience? If you were going to go into, and maybe this has happened in the latest venture, but you'd want a set of cultures and characteristics like this and this from both sides in order for the chemistry to be successful. Would you actually say that you could do that?
Yeah, I mean, I think I could do that. I haven't written it down, but I think pretty much so. What I've done in the Scottish project, we've put in place an advisory board, and that advisory board is a mix of people who have got more of a commercial business bent, as well as people who've been in the public sector, like Bob, for example, who's got the experience of knowing how those organizations operate and think. Because what's critical is if you've got people who are, in the first instance, aligned with the vision of what you're trying to achieve, but can also bring to bear that experience of having the sort of public sector saying, this is how they're going to think, this is what we need to do to align with them. Equally, on the other side, this is what the private sector is going to want. How do we align with them and can not just provide the governance, but provide the advice and insight along the way to help you navigate? Because if I look at the Scottish project, it's been 4 years since I first got involved. It's moved so far forward now. So a lot of people can't believe how far we've managed to get it. But it has required careful navigation the whole way. So on the community side and the public sector side, what they're interested in is jobs and economic regeneration, not necessarily in the profitability. But if I go to a big pension fund or a big investor, they say, well, when am I getting my return? So right now already, if I just use the land as an example, last year or a couple of years ago, we were able to acquire a hotel, but the community didn't have the funding and we didn't have the funding from public sector. But I was able to approach some individuals in the area, high net worths, who said, we aligned with the project, we support you, we'll buy that land. And then we'll be the landlords. And what do you do around that? So following on from that, I mean, we can talk all day about how I've gone about doing it. But there is a charity that's been set up. There is a commercial entity which I've set up as the developer and the management company for the whole thing that has the primary leases. But that will have involvement from the different stakeholders. So I'm looking for private involvement on the board there, as well as community involvement, potentially even other. So looking to get that balance right. What I find in practical terms, you have to have a very clear mandate and you have to have very clear heads of terms and agreements in place, because as a private entity, when you've got to deliver a return from an investor, going back to the risk, you need to be able to carry risk and be able to adapt quickly and do that. Whereas you often find if somebody is just in a charity is less likely to want to entertain much risk at all. So you've got to find the right balance of how do you address everybody's need? How do they get involved so that you're meeting their need of not being exposed to too much risk? But equally, I say, well, stick my hand up. I'm happy to carry the risk, not because of the big reward, but it's a fantastic project. And actually, there is a big reward there if we prepared to back the project and come in.
Sounds like you've got that sweet spot in the middle of all their needs.
Yeah.
I mean, there's obviously social value in what you're doing from the community. And to be honest, compared to the risk of having absolutely nothing in Dunoon, taking a risk on something happening, even if it isn't exactly what they want, is better than, and we're all communities looking for levelling up sort of investment. And it's a bit like in the management of risk, there's got to be enough risk in it to make it commercially worthwhile, but obviously not so much as the politicians and the communities lose their reputation. Well, even the commercial sector lose their reputation. Someone once told me that the best negotiation is where everyone feels they've not got what they wanted. That wasn't the words he used, but everyone feels it's not exactly what they wanted, but there is enough in that little sweet spot Venn diagram between everyone's needs that they can live with it, live with whatever they're not getting and live with what they are getting.
Yeah, I think you actually just said something about reputation, which I think is critical, because, and this is just based on my own very generalized experience, is that on the public sector side, sometimes they're less worried about putting $1 million in and losing it financially than they are about reputation. it's all about reputation. If you lose it and their reputation's grown or still intact, then often that's sort of okay.
Happy days.
But on the commercial side, they don't really care about their reputation as long as you turn their 1 million into 5. So, and particularly with the big pension funds, because they've got pensioners who are sort of at the end of the day are people like you and I that are expecting to have something in place to look to keep them going through retirement. So understanding what the risks are and how they are perceived is critical, because you've got to walk this tightrope to say, well, on this side, I'm trying to get that guy a knighthood, but on the other side, I'm trying to make him a multimillionaire. So.
I don't know if the reputation on the private sector side will be good if you took $1 million and gave them back 250,000, but I guess they have a portfolio of risk, whereas a local authority, well, a little community wouldn't. It would be, this is everything to them, because that they can't live in different places. That's where they live. So did you do a lot of risk mapping with that group of people before you entered into the why, how, and the when? You actually started with that, or did you just get to those points when money was needed and you need to get people to put hands down pockets?
I wouldn't. When I first got involved, I came on as a consultant. It was actually a big fund in London that was working with the community at the time that said, would I go and do? So I wouldn't say we sat down and formally did a risk mapping exercise, but along the way, sort of done that along the way, and it's evolved, and everyone is very aware of what each stakeholder is looking for and navigating through that. So that's reflected in the agreements that we set up and how the overall structure is put together. So even today we say, well, does the charity want a shareholding in the developer, or does it want another route to actually getting a return that it can reinvest in the community, or is it just happy if we can measure and monitor how many jobs? Because even at the community charity level, it's reputational risk that is the biggest issue for them. And so those, I'd say that conversation at the very beginning, everybody just thinks, oh, this is a great idea. We're not going to, it's not a big financial exposure. Go and check whether it's viable, whether it works. And you come back and say, yep, I think it's got a chance of working. And as you go down the line and there's more and more exposure and there's more and more at stake,
people start scratching their beards.
Yeah, and getting more and more twitchy if you do things wrong. But and one thing I didn't mention earlier, we've been working very closely to put what we call an impact framework in place, because I've sort of held right from the beginning, whatever we do in these public-private, and it's with consultants called the good economy. They've come up with this term, and I mention it because of what you mentioned about place-based impact investing. But what this project is a place-based impact project. So, and because of that, you want to be able to measure the critical, the key performance indicators all the way through, whether it's biodiversity, whether it's jobs, whether it's economic regeneration in other ways. But overall, you want to be able to demonstrate quite clearly, whether it's to the community or our stakeholders or to the big investors, that you are making a positive impact all the way through. This isn't greenwashing. We are actually working at delivering on these results. And so that's the direction of travel that we're working in on this.
With that sort of approach, sorry, David, I'm getting too interested in this. Have you had to slow the project up to go back for people until they are happy with the social value returns, the KPIs, be it financial or hard-nosed investment, or even sort of soft place skills issues? Have you had to tread water, because you know that by treading water and getting people back on board, it could be when you went to sort of almost locally crowdfund the acquisition of the hotel, you're just wanting to keep everyone where they are because you will make it through the path eventually. So racing people now doesn't help you get to the end.
That's a very interesting question. I think if there'd been one asset and we were just delivering one thing, like in the cases you mentioned, there's a building that you think this could be turned into something as a place. then I may well have had to do that. But because this has got so many sort of streams, if you like, when one slowed down, I've been able to keep another one moving forward. So overall, if we just followed a sequential line of things, say, okay, step 1, get the land, step 2, do a master plan, step 3, sort of start raising the money for a gondola, which is tens of millions, then I would have had to slow down. Now, your big challenge there is when you've gone in early to get community support, and that was almost the first thing I had to do, is present to an audience of about 500 in a community of around 10,000 or so. Yeah. So a big percentage of what the project, so they bought in and they just keep asking the question, well, when are we going to see something happen? So you've got the pressure to demonstrate progress visibly, but at the same time on the big one, you know it's going to take a few years to get there. It's going to take time to get £50 million in to do the major infrastructure. So what I've done here is I've set up an operating company which is focused on adventure tourism and cycling, because we've got quite a lot of traction there. We've developed a digital ride, a digital twin of an actual ride here, which has had 100,000 riders in 2 months, virtually.
Well, so, like on a Peloton type setup.
Yes, but it's a digital twin of an actual road. So when you do the ride from your lounge, you're seeing actual the moon.
Fantastic.
And in the beginning, people say, well, why do you want to do that? Why do you want to spend money on doing that? And I said, because actually it will be almost the first time anybody's doing it from a marketing perspective, to put a name on a map that nobody knows about. Right now, I've got people in France and around the world talking about the moon, which was unheard of a year ago. So that bit I can accelerate because it is in small startup. I can get EIS investors, well, individual investors, to come in and put a few £1,000s in each, and I can get that moving. Whereas the big infrastructure project is much slower. So then I've got to that moves as it moves. It takes as long as it takes to get planning permission and things like that to do it, and then to raise the funds and everything to do it.
Interesting. Because
so
then you're bringing something back. You're always bringing something from these different streams of work. Fast, slow, immediate, small, large. You're bringing always something news and movement back to either the board or the community. You've got something to announce, or the anticipation of something, which keeps people's hopes up.
Absolutely, and I think that's important.
The other thing that would interest me, Keith, is because that's all, incredibly fascinating, and it is sort of coming at it from the public sector and how the public sector can look at things differently and see that the ROI is more than just financial. But coming back to the financial side, which is, as you mentioned earlier, the interest that's needed from the private sector, do you think there's room for some of the methodologies and some of the financial instruments that are now available in the private sector to bring them into not necessarily the Scottish project, but maybe major projects such as the asset base on the NEC? Many councils are, and I'm thinking of the West Country in particular, many councils are sitting on huge property and physical assets that generate income for and are quite pivotal to the success of a community. And without naming names, Andrew and I both know of a West Country unitary council that owns things like harbours. It owns a number of hotels which house businesses. So the council owns the property but doesn't own the business. And the property obviously needs constant attention, refurbishment, etc., etc. But it has an income stream, as does things like events and what have you. So is it a way of using, and we talked about with another guest a few days ago, we talked about things like securitization of revenue and so on and so forth. The community investing in, say, an operating company that would have private and the public sector to maximize the income from the property, not necessarily the leverage of the asset itself. And I think it's this type of understanding of what's available is in many cases lost to local authorities. And if they knew about it, and if there was someone who could facilitate, think about this, think about that, don't necessarily think in the short term. Although I do appreciate sometimes short-termism is life or death.
Politically, it is. It's 4 years maximum and possibly 6 months minimum.
Yeah, I mean, I think, David, what my starting point, and this is just based on all the experiences that I've had, and I've seen it over and over, is people don't think broadly enough. But the starting point, and if I think to you, I know you're familiar with J. Abrams, is your starting point is to say, what assets do I have on the ground today? And in private equity, we had this thing, we always talk about yield optimization. For every square foot of asset or land or building, am I getting the most return from that? And that you don't have to be a private sector investor, or you can be in the local authority or anyway to say, am I maximizing the benefit of that square foot or that asset that I have? Once you've had a look at the opportunities, then yes, I think there are many, many different ways, and almost every day, even on the project I've got in Scotland, it's, well, if that doesn't work, we could try this. And I always talk, my sort of captain's voyage analogy, which is a different podcast, but I always say, when you're sailing to a destination, it's never a straight line. You've got to be prepared to change course every day depending on what's in front of you. And I think that people often think, but just based on the constraints they have or what they can see in front of them, they think we've got no option. We've just got to, we can't offload it, or we can't do much more, or there's no ways to get a return on it. And the starting point is to get people in. And I always start with saying, okay, what have we got today? Now, what can we potentially do with this asset? And then how do we explore from there? When we've decided on what route we were going to take in terms of what could be done, then you can explore different financial models. So in the Scottish project here, I'm in regular discussions, say, well, how do we structure it commercially? Sort of whether it's the equity splits or the financial. So I know that in the development company, my route to funding is going to be very, very different from the route I take for the operating company. That's the adventure tourism route. But you've got to think, and the financial structure. So I'd probably take on more debt if there's assets in there, because it can be asset backed. Whereas at the bottom end, I want more equity sort of investment in there because there aren't any assets on day one. We've still got to get them. So I'm not going to give you the sort of the Bible verse that says this is the answer, because there isn't only one answer, but there are many options. And the more sort of, if I went in, I'd say, okay, well, if this is the local authority, what constraints does it have in the first place? What is it allowed to do or not? Is it allowed to have a shareholding in a private company that's been set up and run for somebody else? That would be a simple but obvious starting point. If it is, then how can you collaborate? Because the local authority can get access to public funding and the private sector company can get access to private funding. Can you bring the two together? So I grapple with that even on the project I've got. How do I bring public sector funding together with private sector funding? And we've had both. So I don't have a black and white answer for you, but I'll just say it depends.
Well, I think that's really the right answer. That's what I was trying to sort of facilitate, because most authorities do tend to, in my humble experience, and Andrew will qualify it, I'm sure, tend to think, can we flog it, or do we have to outsource it? Or, if we can't outsource it, can we flog it? And that's kind of the two key models. But where that's Andrew and I and others are now seeing the opportunities for the sort of mixed structure dependent upon the asset, yield, how you would actually look to finance it, not only to finance it, then to execute it so that it keeps generating revenues rather than a one-time hit.
I think the third leg of the stool was borrowing previously quite preferential rates for local authorities, but recently the government's got very worried about overexposure of councils to debt, even though those assets, even if they purchased them, trading estates several hundred miles away from where they where the council was actually the yield was good. And there was a sort of a concern that they were overexposed. It wasn't what the council should be doing, even though, to be honest, they weren't getting money through traditional routes. Grant funding had almost disappeared. Council tax is never enough to run the service. So you could understand why local authorities were exploiting long-term borrowing, and many successfully, some less so, which is sort of given the government the reason to say you can't borrow for yield now, and they don't want you sort of investing anywhere outside the borough, which I can see from a political and kind of moral standpoint, a bit like your communities in Dunoon, you know, they're elected or they're representing or they live in a particular area, but at the macro level, CFOs were trying to play the different, you know, very few cards in their hand to try and bring fresh investment into the towns and actually write down a lot of revenue debt through investment income, which sadly often didn't come, or didn't come when it was due. It depends on how good the assessment was. I think what David is saying also is that if we can get out from just having to borrow it, sell it, or outsource it, are there ways of, and this is new to me, of monetizing the potential of that asset, not in its sort of equity, but in its earning potential, and give someone a share of its future earnings? And the previous podcast has sort of exploited this, a way of sort of fractionalizing or factionalizing. And Mike Kessler was telling us this a couple of weeks ago, to try and give people sort of almost a tradable share of that sort of operational, you know, like a leisure centre or whatever, which are fiendishly difficult to manage because you have to heat them a lot, the pool, and the dry side's great, but you have to have a lot of fitness going on to pay down the wet sides. But trying to give us new ways of getting the sort of almost like the crowdfunding you're getting, or the local, and to track that through kind of blockchain to know who's got what and when, and that's all. That ledger is absolutely fixed, and it just fascinates me to see where we could perhaps stop people going around the same loop again, as David mentioned. You know, sell it, you know, let it go moribund, or actually not exploit the, as you said, the leisure. If the council or the community or the charity have got a massive database of people who use what, that's worth, that intellectual property is worth more than the asset sometimes.
I agree. No, and I think, I mean, my whole role in private equity was value creation. And it was going in to say, okay, well, what have we got? And what is the art of the possible? And whether it comes to how do we fund it, how do we build it, where are the unique opportunities? And the guys always used to say, it was fairly hardline private equity approach, is to say, we don't want to be in longer than 3 or 4 years. We've got 18 months to sow, 18 months to harvest. So I think having your timeline and your time phasing and like a particular, those are what I call the coordinates. So how long do we want to take and where do we want to get that? Because it tends to focus the mind. Yeah. So how you track it. So yes, you're right. There's community funded options. There's giving the community themselves a direct stake in it. There's all the way through to big institutional funding, from pension funds all the way through to say who buys into the vision that is willing to come on board. And it's not just financial support you want their ideas and their shaping. And sometimes it can be really hard. How do you get that on board? But that tends to really open up sort of the opportunities and the potential for realizing the value that is locked into an asset. And it is unlocking the value, because I think that is key. People look at something and they like your analogy of the cards in the hand. So I think a lot of these guys have got to hold up their cards and say, well, I've got these 5 cards. And they don't think, well, why don't I pick another one? And what they need to do really is you need to come along and give them the joker in the pack to open up the options, whether it's on every level. So
I like the 18-18 sort of analogy, because in the political horizon, you know, you got a 4-year. Sometimes you can have elections every 3, a third. So you have a fallow year where everyone's out, no elections, and then you have third. So you have a shifting balance of political control. You have the leader or the chairman that wants things to happen whilst they promise their communities X, Y, Z, and they need delivery soon. Sometimes you need multiple of those political cycles in order to build something. You know, you mentioned the gondola. It could be 4, 8, 12, 16 before that happens, but you need to give someone that they were there at the foundation, and even if they pass the baton on, there's political, managerial kudos to doing that, because often managers, they're not politicians, but they want to feel their CV is enhanced because they've bequeathed this as a going concern to someone else. And I'm sure that's very important to the investor, because you need people like that to gather around this rather than, sorry, David, you want to come in?
No, I was just thinking, uniquely in the sort of public-private Venn, for someone who initiates a major project, a major initiative, no matter what happens, they could always say, if it's successful, they could always say, that wouldn't have happened if it wasn't for me. Doesn't matter who takes it on. But if it doesn't meet all expectations, he would say, it was going all right until I handed it over. So I'm just a little bit of a
you can get something out of it.
Yeah. But coming back to the council, or whatever is the public sector, even NHS or ambulance services or other services, there's got to be a way of thinking about how we can create an environment where, and I think I like the word that you use of impact. So how can we get the impact so that we're not just looking at money, which obviously drives the whole thing, but we need to have that sort of perception within the vision, the alignment of the vision that you talked about, that its impact as much as not costing an arm and a leg, or the whole farm.
Yeah, and I actually, Rich, I sort of always used the impact word in the past, but sort of as I've worked on these projects, I like the whole term place-based impact.
Right.
How do you pick a place, whether that's a piece of ground in the middle of a town, or it's a big area, or it's a whole town or a big area, and say, well, if we look at the whole thing, what do we do as an initiative to create a positive impact on that place? And there are people like I know in the sort of in the funding sector that are saying, yes, we want to pick an area and invest in that, but we need to see what the returns are. But what that does, it immediately opens it up. So right now I look at this area and I say, well, if my asset that I start with is, the first hurdle is get the rights to develop the land, then I say, well, what's my land footprint and what can I do on it? Then I say, well, I can do adventure tourism. I could do some renewables on there. I could put up some accommodation. Then I'm starting to maximize the yield from that underlying asset. And in a different area, I think we talked about, where was it, down south, various projects you've heard, David.
Yeah.
There's, even if I think of the Cape Town waterfront, at one stage it was a harbour that was rubbish. You wouldn't want to go and visit that other than to just be interested in ships coming in and out. But now if you go there, it's a thriving economic hub that's had massive investment over many years now. And I think there's examples like that in the UK, but it's taking what's the underlying asset and what do I need to do to that asset to grow it out. But it's a place. Pick your place and say, and that's what I think, where I think a massive opportunity is for the councils, is to say, well, they're probably not going to do it on their own. I know we had a bit of level of the first round of the renewal fund last year for this project, but they need to be collaborating to get better results. And Andrew, the 18 months, I also like that even in the public sector world to say we don't have forever to do this. We need to concentrate minds, because that also drives innovation and creativity, to say we need this now. How do we drive it forward?
Keith, did the Scottish government or the UK government provide sort of initial seed corn, like a levelling up fund to get you going on this, or was it just completely from scratch?
The initial funding was private sector. That was from a London fund, but that was a bit. And there were some individuals who put money in just to get it going. But then subsequent to that, we did win grant funding from the Community Renewal Fund. which we needed to be able to get the master plan developed and to build a team, to put a team in place. And so that was absolutely critical. And I've had many discussions with the Good Economy and others to say, the biggest thing here is not the ideas and it's not the opportunity. The biggest issue is that seed capital to get going. You'll find people that are willing to give it a shot, but you can't do this on fresh air. And getting people's minds, they're happy. I've been told over and over, well, come back to us when you're shovel ready. And I said, you don't understand. When I'm shovel ready, I'll have 10 people offering me money. It's getting to shovel ready that is the biggest issue. So I think that's another area. So if the council could say to me or you, say, look, we'll give you $500,000 or $1 million to get us through to shovel ready or whatever it takes, then they're carrying the big risk capital. But it's you could then say to them, look, there's a chance this might not work, but if it does, this is where we could go to give you a much bigger return, give you the jobs, help you win the next election, whatever it is.
And with the impact, the place-based impact measurement, can you kind of divide equity capital or private sector investors along the lines of people that are very interested in that and those who are not interested at all? Does it self-select the sort of investors you get or the companies you've represented in the past because of their interest in, well, sort of CSR has an element of, obviously there's a financial return they want, but it's quite hard work, as you've said, to thread everything together, and that might self-select some that they're in for the journey, and others say no, we'll just go and build a battery factory in Northumberland and lose our money there. Whatever.
It absolutely does. So I mean, I'm working with some corporate lawyers as well who are helping me shape exactly that. So you find I do a lot of work around investment readiness with companies, and a big part of that is say, okay, this is who you are and this is what you have. Who are the right investors to be approaching? So you will find some investors that are interested in sort of renewables and others that are more interested. We're interested in funding a building. Others that are more, we high net worth investors, we're interested in the tax release we get out of that. So positioning what you're trying to do for the right pool of investors and then going to them, you're far more likely to get a positive response. So you don't just go and blanket approach to everybody. You say, you shape yourselves. I always say to people, when you're trying to sell your house, if you know the guys that's most likely to buy wants pink carpets and green walls, then you go and do that before he comes to your house. Because he'll give you more money for that house because it's ready to go than if you don't, or more likely to buy it. And I just see that with businesses. I say, decide 3 years out or right now, who do you want to attract? And then start painting the walls the right color and putting in the right carpet so that you actually are, when they come and look at you, they say, yep, that's exactly. And I'm doing that with the impact fund because I know there are funds out there who are interested in impact. So I shape it and I go to them and I walk into the office and say, we're doing this. This is what we're measuring. This is where we want to go with it. This is the big vision.
Thank you. Yeah.
I think there's part 2 of this podcast starting to build a momentum, but I'm very, very conscious in the meantime, Keith, that we've taken up a huge amount of your time, and I think I'd like to come back to you, and we need to keep this going, and it actually comes together with some of the other guests that we've had on, and maybe we could think about hosting a small event, an online event to widen the audience, other than the 2 subscribers we've got to the podcast series. So if it's okay with you, should we hook up outside of the podcast and see where we might take this? And because I think it's definitely painting a more richer and with greater tone than just do it this way or do it that way. And I think you're right. It's the if you like the deal structure and the deal framework that the local government in particular need to think about, not just the cash that's in the pot.
Thank you, Keith.
No.
So if it's all right with you, Keith, can we do that? Can we wrap it up here?
Yeah,
And then
absolutely. Yeah, and it's
and
been a
then
pleasure to be on.
yeah,
Thank
and
you.
outside of that, then we'll think about part 2 and what we might cover off there from the subject matter, and then we'll go from there. So
I'd love to know what a gondola is, though, before you go. It basically is a gondola.
Cableway. Yeah,
Hey?
like when you go skiing and you get in a
Oh,
gondola to
that
take
one.
you up the lift. You're like a pods on the cable, so it's more than a
Of
chair
course.
lift.
More than chair views,
But
experience. Wow.
yeah, and that's the big thing with the Noon is the views are absolutely stunning. So there's a lot of people, not just for the mountain biking, but for walks and trails, and to just go and sit in a restaurant at the top and look out over the Clyde Bank.
Fantastic.
In fact, we took the chairman of the land, or the CEO of the land commission up to the top. He said it was the first time he'd seen the Clyde Basin for real, not just on a map.
Well,
so it is stunning.
Well, that's great. Thanks, though, Keith.
okay,
My
so
pleasure.
I'll bid you farewell, Keith, and
Thanks, David. Thanks, Andrew.
Thank you.
We'll wrap up here. But if you hang on for a couple of seconds.